Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Navigating Sovereign Risk, what it means for global investors in 2024. Impact of sovereign risk on investments. Sovereign risk isn't just a financial term, it's a pivotal factor in shaping global investment strategies. When you consider investing across borders, understanding the sovereign risk can guide you like a lighthouse in choppy seas. Let's unpack its impact on different investment classes. Implications for foreign direct investment, FDI. Foreign direct investment is often seen as a barometer of economic health. But how exactly does sovereign risk influence these investment decisions? Investment environment uncertainty. High sovereign risk can deter FDI, as investors may worry about the instability of their investments. If a government may struggle financially, it could affect the security and potential returns of FDI projects. Regulatory challenges. Countries with high sovereign risk might introduce sudden policy changes that impact foreign businesses. This regulatory unpredictability is akin to changing the rules of a game halfway through, causing potential investors to hesitate. Return on investment, ROI. Sovereign risk can significantly affect ROI. For instance, if a country encounters a debt crisis, profits may be repatriated at a devalued rate, impacting returns. Ultimately, when sovereign risk is high, potential for loss looms over the previously reliable promise of profit. Effects on bond markets. The bond market is particularly sensitive to changes in sovereign risk, especially in emerging markets. The relationship between risk and bond yields is core to investment strategy decisions. Impact on yields. Higher sovereign risk typically leads to higher bond yields. Investors demand more return to compensate for the increased risk of default. It's like needing a bigger umbrella when the storm intensifies. Credit spreads. In emerging markets, sovereign risk can widen credit spreads, reflecting a lack of confidence in a country's economic stability. This widening makes borrowing more expensive for these countries and could trigger a downward financial spiral. Market volatility. Perceptions of sovereign risk can lead to significant bond market volatility. If investors anticipate a downgrade in credit ratings, they might sell off quickly, causing drastic shifts in bond prices. For bond investors, understanding sovereign risk is crucial in assessing the risk-to-reward equation. Always remember, in the world of bonds, peace of mind often comes at a price. This intersection of risk with various investment classes underscores the importance of diligent analysis. Staying informed on sovereign risk factors is key to navigating the complex global investment landscape smoothly. Case studies of sovereign risk. Sovereign risk isn't a concept locked in textbooks. It's a harsh reality seen in the financial challenges faced by countries worldwide. Nations grappling with economic missteps often leave ripples on the global stage. Below are 2 pivotal examples that highlight the gravity and consequences of sovereign risk. The Greek debt crisis. The Greek debt crisis serves as a textbook example of sovereign risk gone awry. In the late 2000s, whispers of financial instability turned into a full-blown crisis, leaving Greece grappling with significant economic turmoil. But what caused this spiral, and what were its implications? Economic mismanagement. Greece's financial decline was largely attributed to excessive government spending and rampant tax evasion. It's like running a business with generous spending but ignoring unpaid invoices. Eventually, the debt mountain becomes unmanageable. Eurozone membership. As part of the Eurozone, Greece's economic policies were tied to a broader monetary system. The inability to devalue its currency as a tool to boost competitiveness weakened Greece's response to the crisis. Austerity measures. To secure bailouts, Greece had to adhere to strict austerity measures, impacting public services and employment. Imagine a household on a budget cutback, with essentials being sacrificed. This strain led to social unrest and political upheaval. Global ramifications. The crisis threatened the stability of the entire Eurozone. It sparked debates on fiscal policy, leading to market volatility. For global investors, it underscored the importance of assessing sovereign risk when investing in interlinked economies. Greece's struggle taught the world that financial complacency can rapidly escalate, affecting not just a country's economic health but also its social and political fabric. Argentina's default in 2001. Argentina's default in 2001 is a cautionary tale of sovereign risk grounded in economic fragility and policy missteps. But why did Argentina's financial house of cards collapse, and how did it affect the global market? Currency peg and economic crisis. The peso was pegged to the US dollar, creating a facade of stability. However, as the dollar strengthened, Argentina's exports became less competitive. Imagine trying to sell lemonade, but the price of lemons doubles overnight. It's a recipe for financial disaster. Mounting debt and political instability. With debt accumulating and political instability brewing, trust in Argentina's ability to manage its finances eroded. Efforts to stabilize the situation through austerity measures resulted in social unrest. Declared default and aftermath. In late 2001, Argentina declared a sovereign default, the largest at that time. It was akin to hitting an economic iceberg, causing profound damage to its credibility in international markets. Lessons for investors. The default highlighted how currency policies and political challenges can drastically impact sovereign risk assessments. For investors, it stressed the importance of examining not only economic numbers but also underlying fiscal strategies and political dynamics. Argentina's financial collapse is a stark reminder of how delicate economic equilibria can be, and the wide-reaching impact when that balance tips. Understanding such case studies informs both current and future approaches to sovereign risk in investments. Managing sovereign risk. Managing sovereign risk is not just a finance expert's headache, it's a challenge for anyone staking their claims in international waters. Whether you're an investor or policymaker, finding ways to handle this risk can feel like threading a needle in a storm. But fret not, understanding clever strategies can lead you toward calmer markets. Diversification strategies. When it comes to diversification, it's best to think of it as spreading your bets. No one wants all their eggs in one basket, especially when that basket's threads could unravel at any moment. Here are some savvy ways to diversify and mitigate sovereign risk effectively. Geographic diversification. Invest in multiple countries rather than focusing on a single market. By spreading investments across different regions, you reduce the impact of a single nation's economic collapse on your portfolio. Asset class variety. Mix it up with a range of assets, stocks, bonds, real estate, and perhaps even commodities. Each one reacts differently to economic shifts, helping buffer against specific sovereign risks. Industry spread. Do not limit yourself to one industry. Each sector faces unique challenges. By diversifying across industries, you can ride out sector-specific downturns in one country without taking major hits. A smart mix means you're not relying on just one thread to hold everything together. This approach keeps your investments resilient, regardless of how the economic winds blow. Investment insurance and hedging. Insurance and hedging are your financial airbags, ready to cushion the blow if things go awry. Here's how you can use these tools to protect against sovereign risk. Political risk insurance. This insurance covers losses from political events, such as expropriation, inconvertibility, or contract breaches. For investors in volatile regions, it's a security blanket offering peace of mind against unpredictable political currents. Currency hedging. With currency fluctuations a constant threat, especially in emerging markets, currency hedging can lock in exchange rates and guard against devaluations. Think of it as stabilizing your ship amid choppy economic seas. Credit default swaps, CDs. These are like financial insurance policies against defaults on debt. Investors use CDs to protect themselves when lending money to governments with shaky credit standing. Utilizing these instruments wisely can not only cushion unexpected turbulence but also provide a sense of control in a seemingly unpredictable financial journey. Each method contributes to a more secure investment landscape, ensuring you're better prepared for the financial tides ahead. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.